Remember the last time a headline hit war? Tariffs, a surprise election twist, and you said, "It's just noise." Then watched your portfolio gap down before you could blink. That's the expensive mistake. Ignoring geopolitics until it's already in your prices. Let's make sure you don't pay that tuition again. Alright, here's what's going on, and more importantly, why markets are reacting the way they are. When you hear a sitting US president publicly floating ideas like taking over Greenland or talking about exerting control over Venezuela, whether that's literal acquisition, leverage, influence, or a more aggressive posture, your first instinct might be to treat it like political theater. But markets don't get paid to have instincts. Markets get paid to price risk, and that's the real story. The moment political talk becomes policy tools, tariffs, trade restrictions, defense posturing, sanctions, alliance pressure, assets start repricing in real time. Not because investors love drama, but because uncertainty has a cost, and the cost shows up as a higher risk premium. Let me frame this in the simplest way possible. A headline doesn't move markets because it's important. A headline moves markets when it changes expectations about cash flows, inflation, interest rates, and global trade. That's it. That's the engine. So, let's break the situation into 3 layers. The territory narrative, the trade war mechanism, the commodity and currency implications. Because if you understand those 3, you stop reacting emotionally, and you start positioning intelligently. First, Greenland and Venezuela aren't just land. They're leverage. People get distracted by the map. They start measuring square miles, comparing it to the Louisiana Purchase, talking about the biggest expansion in history. Fine, interesting trivia, but markets care about what sits underneath the land and what the land enables strategically. Greenland matters because of Arctic shipping routes as ice patterns shift, military positioning in the North Atlantic, and, yes, minerals, especially rare earths and industrial metals, that feed high-tech supply chains. Venezuela matters because of oil reserves, regional influence in the Americas, and the larger signal it sends about U.S. posture toward resource security. Now, I'm going to be careful here. Control is a slippery word. It can mean anything from friendly agreements and commercial dominance to sanctions pressure to regime change fantasies to a simple negotiation tactic aimed at someone else entirely. When you introduce a low probability, high-impact scenario like major territorial pressure or a sharp break with allies, investors reprice the tails. Even if nothing happens, the mere possibility forces repositioning. And that leads to the second layer, trade. In your notes, you mentioned the tariff announcement starting at 10% on multiple European countries, with talk of rising to 25% by a set date if a deal ain't reached. Whether the exact details stick or shift, the market logic is the same. Tariffs are not just a tax, they're a transmission mechanism. Here's how tariffs ripple through the system. Tariffs raise input costs. Higher input costs raise inflation pressure or compress profit margins. Inflation pressure makes central banks less flexible. Less flexibility means rates stay higher for longer, or at least the market fears they might. Higher expected rates compress equity valuations, especially in growth stocks. Meanwhile, companies reliant on cross-border supply chains face uncertainty, delays, and renegotiations. That uncertainty reduces business investment. Reduced investment hits productivity expectations, and suddenly your political headline is now a real economic variable. This is why you'll often see stocks wobble even when a tariff is only 10% or only targeted. Investors aren't pricing the 10%, they're pricing the escalation path. Trade wars aren't about the first punch, they're about the second and third punch. Retaliation is the entire game. If Europe signals countermeasures, trade defense mechanisms, restrictions, regulatory friction, procurement shifts, then you don't just have a US-EU disagreement, you have the world's largest economic relationships running hotter. And when trade relationships run hotter, global growth expectations cool down. That's why you'll see cyclical stocks soften, shipping and industrial names react, certain commodities spike, safe havens catch a bid, and currencies move based on risk-on versus risk-off behavior. Now layer 3, commodities and currencies. This is the part most people mess up because they treat commodities like a sideshow. They're not. Commodities are where geopolitics becomes real. If you even whisper resource nationalism, Investors immediately think who controls supply, how reliable that supply is, and what price has to be paid for future access. Oil is obvious. If Venezuela becomes part of a pressure campaign, an investment opening, or a strategic chess piece, energy traders don't ask for a signed treaty. They ask, does this increase disruption risk or does it increase supply potential? And remember, volatility itself is a cost of capital. Now step into metals, rare earths, copper, nickel, graphite, and the industrial inputs that underpin electrification, defense manufacturing, and high-end computing. If a major power signals it wants tighter control of those supply chains, you're going to see speculative inflows into miners, processing capacity plays, strategic material ETFs, and sometimes even the currencies of countries perceived to be resource-rich and politically stable. This is the part that's easy to say and hard to invest, because owning resources is not the same as owning profitable resource companies. A country can have trillions in underground value and still be an awful place to deploy capital. Which brings us to Venezuela specifically. Yes, the reserve numbers are massive, but reserves are not production. Production depends on infrastructure, capital investment, technical expertise, legal stability, export access, and time. A barrel in the ground is not the same as a barrel delivered to market at competitive cost. That distinction separates serious investors from headline tourists. Now let's talk about the one asset that always shows up in these moments: gold. Whenever geopolitical tension rises, gold tends to attract attention because it behaves like a trust barometer. Not always immediately, not perfectly, but conceptually, gold benefits when investors question the stability of policy, currencies, or real rates. And here's the key: gold doesn't need the world to end. Gold just needs uncertainty to rise and real yields to look less attractive. If central banks are buying, if fiscal deficits remain large, if geopolitical tensions increase, gold becomes a portfolio hedge, not because it's magic, but because it's an alternative reserve asset that isn't someone else's liability. And here's the key: gold doesn't need the world to end. Gold just needs uncertainty to rise and real yields to look less attractive. If central banks are buying, if fiscal deficits remain large, if geopolitical tensions increase, gold becomes a portfolio hedge, not because it's magic, but because it's an alternative reserve asset that isn't someone else's liability. The correct framework is: you build hedges when volatility is cheap, you rebalance into strength when volatility is expensive, and you never let a single asset become your entire personality. So, what should an investor actually do with all this? Let me give you a decision framework I've used for decades, including through periods when headlines were moving markets every single day. Step 1. Separate theater from policy. Presidents talk. That's their job. Markets move when talk becomes policy. Tools, tariffs, sanctions, restrictions, defense spending shifts, alliance breaks. So ask, is this a negotiation tactic or a structural shift? If it's a negotiation tactic, volatility spikes and fades. If it's structural, correlations change, supply chains shift, and the repricing lasts. Step 2. Watch the calendar and the escalation ladder. Markets hate deadlines. Deadlines force decisions. If there's a stated date where tariffs rise or negotiations expire, you can expect positioning ahead of that date. The biggest moves often happen before the event, not after it. Step 3. Look at the winners and losers by mechanism. Tariffs and geopolitical risk tend to pressure consumer discretionary if prices rise, pressure exporters tied to cross-border demand, benefit domestic defense and strategic manufacturing, benefit certain commodity producers, and boost perceived safe havens. But don't do this lazily. Defense goes up is not a strategy. Valuation matters, balance sheets matter, government procurement cycles matter. Step 4. Respect currency dynamics. In risk-off moments, investors often pile into the US dollar until they don't. If the US is the source of trade escalation, sometimes you get a more complex currency reaction, the dollar up on safety demand, then down if investors worrying about long-term credibility or fiscal implications. That tug-of-war is why you can see gold and the dollar rise together in short bursts, because the market is not telling one simple story, it's pricing multiple fears at once. Step 5. Don't confuse volatility with opportunity unless you have a plan. This is where people get wrecked. They see markets dip and think, buy the dip, or they see commodities spike and think, momentum, or they see a meme narrative and think, this is the new world order. No, you need rules, position sizing, time horizon, and predefined exits. If you don't have exits, you don't have a strategy, you have hope. Now, let me address the bigger psychological trap here, the one that hits retail investors every single time. Geopolitical headlines create FOMO into directions. FOMO that you'll miss the upside if a big resource control narrative becomes real, and FOMO that you'll lose everything if the world breaks. Both forms of FOMO push people into bad timing. They buy risk assets after rallies, then panic sell after drawdowns. They buy hedges after they spike, then dump them after they cool off. That's not investing, that's emotional whiplash. Here's the reality I've seen again and again, including in crisis years. Most geopolitical shocks don't end the system, they reprice parts of the system, and the investors who do well, the ones who treat uncertainty like a variable, not a verdict. So, if you want a practical way to think about this, Greenland, Venezuela tariff, Davos swirl, think in scenarios. Scenario A, it's negotiation theater, tariffs get walked back, allies posture, markets stabilize, and risk assets recover. In that world, overreacting costs you returns. Scenario B, it's controlled escalation, tariffs persist, EU responds selectively, supply chains take modest hits, growth slows at the margin, inflation stays sticky, and valuations stay under pressure. In that world, quality balance sheets and pricing power matter. Scenario C, it's structural fracture, major trade blocks harden, defense posture escalates, commodity security becomes national policy, and global capital gets more political. In that world, diversification across geographies, real assets, and sectors becomes non-negotiable. You don't need to predict which one happens with 100% confidence. You need to build a portfolio that doesn't collapse if you're wrong. That's the difference between speculating on headlines and investing through cycles. Now let me end with the one takeaway I want you to remember when leaders talk about territory, control, and tariffs. Markets aren't reacting to the map. Markets are reacting to what it implies: higher uncertainty, higher friction, and a higher cost of doing business across borders. That shows up as volatility, it shows up as repricing, and it shows up as opportunities, but only for the people who stay disciplined. So, if you're watching this and thinking, what do I do right now? Do this: tighten your risk management, rebalance instead of panic, keep cash as an option value, avoid leverage unless you're a professional who can absorb drawdowns, and stop letting headlines decide your portfolio. Because the market's job is to transfer money from the impatient to the patient, and geopolitical cycles are one of the fastest ways that transfer happens.